Most investors have, of course, heard of floating or adjustable interest rate debt, such as adjustable rate mortgages. Most investors are also aware that interest rates are currently rising, and the more interest rates rise, the more credit risk rises. Put another way, the more interest rates rise, the more interest rate risk effectively becomes credit rate risk. With that in mind, I don't think investors entirely grasp how much financial risk has entered the global economy via floating rates, especially when it comes to the knock-on effects of rising interest rates on residential mortgages. It's something that U.S. investors in particular might easily overlook because the vast majority of mortgages in America are fixed rate. As you can see on this table, based on recent stats, 70% of all U.S. mortgages are 30-year fixed rate, and roughly another 20% are either 15-year fixed or some other fixed long-term. But in much of the rest of the world, it's a very different story and one you should keep an eye on. Take a look at this chart. Note how many of the 20 largest economies in the U.S., I've included the UK despite Brexit, have 30% or more of their mortgages structured as floating rate. In aggregate, you're looking at a huge number. As we turn to the rest of the world, it only becomes more concerning. Look where Australia, the 12th largest economy in the world, lands in this Fitch ratings ranking by country of risk exposure to rising interest rates. As the third largest economy in the world, Australia's neighbor to the north, Japan, has a massive impact on the global economy. Their domestic mortgage market totals around 1.5 trillion US dollars. Look at how frequently and by how wide a margin housing loans increase via the value of housing assets in Japan versus the US. About 74% of borrowers in Japan choose variable rate mortgages. What happens if rates continue to rise there? A 0.1 percentage point increase, that's a 0.1 percentage point, not a 1 percentage point increase, in loan rates will likely boost the cumulative interest rate burden there by 110 billion yen. As with elsewhere in the world, the more rates rise, the more defaults you're likely to see. The Japanese mortgage market is uniquely brutal because housing loans in Japan typically don't have a non-recourse feature. So if borrowers can't repay loans, and their property is worth less than the outstanding balance, they may be forced to sell other assets to meet obligations. Now let's get back to the broader issue of how interest rates, variable rate debt, and asset values interact. Homeowners who opt for variable rate mortgages not only get financially run over when rates rise, they get hit twice. Naturally, their monthly payments go up, typically much more than most people expect. This is just one example, but assume you put 20% down on a $450,000 home purchase with a variable mortgage rate set at 3%. Now assume that rate, due to rising interest rates, increases to 7.5%. Much higher, but not all that high. As you can see, your monthly payment makes a massive leap. It increases by over 65%. Now I mentioned that homeowners using variable rate mortgages get hit twice financially. Because rising interest rates make homes less affordable, they cause home prices to drop. So at the same time that your monthly payment is going up, the value of the home you just bought is dropping, sometimes dramatically. You're now struggling to make the monthly payment on a home that, due to the outsized impact of relatively small interest rate increases on home values, is now worth perhaps significantly less than you paid for it. With that 1-2 punch in mind, I'll close with this question. What happens to global spending, and as a result, the global economy, as rising rates and falling home values increasingly impact homeowners' discretionary spending? Think about it, and be careful out there.